Okay, cost of capital. So in strategic financial management, cost of capital can be seen the costs of fund, that's the overall fund that is used by a business, that is used to finance the business, the overall fund. The cost of financing a company can either be cost of equity, just as explained earlier. That's if the company is financed by all equity, the cost of capital becomes the cost of equity. If there's no debt, that means there's only equity. The cost of capital will be the cost of equity, or the weighted average cost of capital. So a company that has debts and equity, the cost of fund will be the cost of debt plus the cost of equity. That will be the overall cost of funding the business. And that overall cost of funding the business is known as the weighted average cost of capital. In this tutorial, we'll be looking basically at the cost of equity capital. So what is the cost of equity capital? It is the minimum required rate of return that investors expect as the minimum rate of return that they expect to compensate for the risk of investing in a particular company. So if we have company A, B, C, X, Y, Z, and maybe X, Z, X, operating in the manufacturing industry, both companies are producing cements in the same line of business. The risk fixing ABC, XYZ, and XZS will be the same risk. So as an investor, if I'm investing in ABC or any of these companies, if I'm expecting ABC to be paying 30% premium on my capital invested every year, another investor in XYZ should also be expecting this, and everybody in that industry basically should be expecting 30%. That is, if the three companies are all equity financed. So you'll be expecting 30% here, 30% here, 30% here. Because if they are all equity financed, the business risk for the three companies will be the same, and there will be no financial risks. Financial risks here will be zero. But if these three companies are not all equity financed, that means the financial risks of each of the companies will be different. And as a result, the cost of capital for the three companies will be different. And investors' expected rate of return for the three companies will also be different. But let's not look at the financial risk aspects for now. Let's just look at the simple way of defining the cost of capital. So it's just the minimum rate of return that investor expects from their investments. And there are only two methods in your strategic financial management exam that you will be asked to use to calculate the costs of equity capital. So cost of equity capital is either you are using the CAPM, capital asset pricing model, or you are using the dividend valuation model. So number one, number two. These are the only two methods your examiner is going to ask you to use to value an investment or to get the cost of capital. I will start with the dividend valuation model because it's a simpler method to understand than the capital asset pricing model. So the capital asset pricing model is easy to calculate. Let's look at the dividend valuation model. What does it entail? As an investor, I want to invest my money in the capital market. I want to buy shares. How do I value that investment? Okay, so this is the dividend valuation model. What is this model all about? The dividend valuation model. Dividend valuation model. So before I go further to explain the dividend valuation model, the cost of capital, which is KE, simply we say it is the return that investor expects from their investments. So, and here we are basically looking at the stock markets. So for calculating your cost of capital, you are basically looking at the stock markets, investors buying shares, that you can either use the dividend valuation model to value that investment in share, or you can also use the capital asset pricing model to value that investment in share. Assuming I want to buy a share from company A, B, C, and I'm trying to know what should the value of that share be based on the indicators that are available in the markets. So for the capital asset pricing model, what you want to look at is dividend. You're looking at your dividend to value that investment. So assuming, if I go to the calculation, let me just read the introduction. So the second model that can be used to calculate the cost of equity capital is the dividend valuation model. Using this model, it is assumed that the company will continue to exist in perpetuity. So what does this mean? It means that you're expecting the shareholder to hold that share in perpetuity. We are not looking at you buying the share today and selling it tomorrow. We are not looking at arbitrage, but we are looking at someone who wants to invest in a long-term investment, as you are buying the share and you are holding it in perpetuity. So if that is the case, the cost of capital will be the ratio we calculated as the ratio of dividend. Your dividend is your return on investments. So the market value of the share, which is the amount that is invested. And this is the simple formula for calculating the cost of equity capital used the dividend valuation model, which is costs of equity is equal to dividend all over market value of equity. Let me just do a simple example illustration here. So, for example, if you purchase a share at the price of 100 naira. So if I'm buying a share at 100 naira, it means that my investment in share is 100 naira. That's my capital. That's what I'm investing. At the end of the year, I receive a dividend of 10 naira. So this become my investment, while this become my return. So it means that this 100 naira, which is the investment, has yielded 10 naira as dividend at the end of the year. So this 10 naira, if I want to express it in percentage, I'll say return, which is 10 all over my investment, which is 100 naira times 100, and that will give me 10%. So it does mean that my cost of capital is 10%, which is the return that I expect to get from my investments, 10%. Now let's take it a little bit further. In this scenario, let's assume that I have the company's financial statement for the past 5 years, and I look at the financial statement for the past 5 years, I saw that the company has been paying 10 naira, 10 naira, 10 naira, 10 naira. So my expectation is that the company for the foreseeable future will continue to pay 10 naira, 10 naira, 10 naira, because from history, they've been paying 10 naira, and I can use history to project, to forecast what dividend payments will be in the future, right? So if you look at this formula, I just assume that the investor will be receiving 10 naira in perpetuity. What if from the financial statements, the company paid 10 naira 5 years ago, 15 naira 4 years ago, 20 naira 3 years ago? You can see that there is growth in dividend payment from 10 naira to 15 to 20, maybe to 25, and just like that. So if this is the case, I'm going to use a different formula to calculate the costs of equity, the return to investor. And the formula that I'll be using here will be a formula that will factor in that growth in dividend payments. Now, based on the dividend valuation model, we assume that this growth rate, which is G, in practical, it may not be so, will grow in a linear manner. So if I said in practical, it may be 10 naira this year, next year maybe 11 naira, the other year maybe 15 naira. So there's no relationship between the growths. But for your exam purpose, the assumption is that if the dividend is going to grow, it will grow in a linear manner. So that it will be easy to calculate and use a formula to do that calculation. So if there's going to be growth, instead I use this formula or this formula, but both formula are the same. What do I mean by that? D naught, let me go back to the former example. D naught is equal to 10 naira. D naught here is current dividend. Current dividend. As a shareholder, it is assumed using the dividend valuation model that the first dividend that an investor will be received in a year's time, in 1 year time. So in 1 year time, if I have invested 100 naira, I'm expecting that I'm going to get 10 naira after 1 year. That's the first dividend payments. Okay, if you look at the formula, the first formula, we use D naught all over KE all over market value of equity. So here we didn't use D1 all over MVE. But remember that we said the first dividend will be received in a year's time. So it should have been D1 over market value of equity. Is that correct? Yes. But if dividend will not be growing, if it will be 10 naira this year, 10 naira next year, 10 naira the other year, it means that D naughts will be equal to D1. So even if I use D naught, which is 10 naira, to value the investment over 100, it will still be the same thing as using D1, because both D naught and D1 will be equal to the same. But if the dividend will be growing to this dividend, D naught, which is the current dividend, will not be equal to D1 because of what? The growth factor. So if that is the case, this formula will be employed. Let me explain the upper part of the formula. 10 naira, or let me say dividend of 100 naira today. And in the question, you are told that dividend will grow by 10% annually. So it does mean that my D1, that's dividend in a year's time, will be equal to D naught into 1 plus G. In this situation, my D1 will be equal to D naught, which is 100, into 1 plus 0.1. So 1 plus 0.1 is the same thing as 1.1. That means dividend in a year's time will be 110 naira. So this top part of the formula is used to tell you what the dividend will be in a year's time. If your examiner gives you D naught and there's going to be growth in dividend, it means you are going to use this formula D naught equal 1 plus G all over market value of equity plus growth. But if your examiner gives you D1, if your examiner gives you D1, then what should you do? Should you say D1 into 1 plus G? No. If you say D1 into 1 plus G, that will give you D2. So since the examiner has given you D1, all you have to do is just to use the second formula, D1 all over MVE plus J. So when you are given D1, this is what you are expected to use when there's growth. If you are given D naught, this is what you are expected to use when there is growth. So let's look at a simple example. XAY company has just paid a dividend of 50 kobo. The current share price of the company is 4 naira. Calculate the cost of equity using the dividend valuation model. So before looking at the solution, I can see that this has just paid a dividend and I want to invest. That means this is now. This is D naught. The current share price of the company is 4 naira. Calculate the cost of equity. I didn't see any information about G. So it means there's no growth. So this is very simple. I just say 50 kobo all over 4 naira. 4 naira will be 400 kobo. Or else I use 50 kobo is 0.5 naira all over 4. Let's look at the solution. So this is the solution. 50 kobo, your dividend share price 4 naira, and this is your formula. So it means the cost of equity, the return to investors will be 12.5% annually. Now, this formula, MVE here, means market value of equity excluding dividend. Market value of equity excluding dividend. So that's why we were told that dividend has just been paid. That means it is ex-div. If you are told that dividend has not been paid, the market price will be cum-div. That means it includes dividend. Once it includes dividend, you cannot use it straight in this formula. You first of all remove the dividend to make it ex-div before you calculate the market, before you calculate the cost of equity. So let's look at these notes. If dividend is yet to be paid, it means that the market price is cum-div. There will be a need to deduct the amount from the share price before calculating the cost of equity. So example here, If the dividend is yet to be paid in the previous example, the calculation will be different from this. So let's assume that the company dividend is 50 kobo, market price of the company share is 4 naira, and you are told that dividend is yet to be paid. Your calculation will be different. You need to convert this 4 naira to what? X div. But in the previous question, we're told that dividend has been paid. That means it is X div. But if dividend is yet to be paid, it becomes cum div. So how do you do that? Your formula 0.5 all over 4, which is cum div minus dividend that is yet to be paid of 5. That takes you to X div. Then the final answer becomes 14.3%. Second example, XYZ company has just paid dividend of 50 kobo. Has just paid dividend of 50 kobo. That means this is X div. There's no need deducting this 5 naira from the market value of the share. The current share price is 4 naira. Calculate the cost of equity using the dividend valuation model. Assume that dividend has grown by 5% over the past 5 years. So if that's grown by 5% over the past 5 years, we also expect from our forecast that it should continue to grow by 5%. If that is the case, this formula will not be appropriate, but we are going to be using the formula that captures growth. So now, should I use D1 all over KE minus G? Sorry, all over MVE. Let me take this again. So should I use D1 all over market value of equity plus G? Or should I use D naught into 1 plus G all over market value of equity plus G? So the answer is, what was I given? Is it D1 or D naught? XYZ has just paid a dividend of 50 kobo, so this is D naught. The current share price is 4 naira. So if that is the case, I'm using this formula D naught into 1 plus G all over MVE plus G. And that will give us 18%. That's going to give us 18% if we do that calculation. So let's do that calculation and see what's going to give us. So KE is equal to, so this should have been, our dividend should have been there, which is 50 kobo. K is equal to 0.5 into 1 plus 0.05 all over 4. That will give 18.1%. That will give 18.1%. Now, the growth rate was given in the example, but your examiner may not give you this growth rate of 5%, and you may need to do that calculation on your own. So how do you do the calculation? The examiner will give you information that will aid your calculation. So how do you calculate the growth rate if it is not given? There are two basic methods of calculating the growth rates. The first is the Gordon's growth model, and the second is extrapolation. Gordon's believe that companies that retain, now remember, your profit after tax is the profit attributable to ordinary shareholders, but not all of this money will be paid as dividend. Let's assume that the profit after tax is 300 million. The profit after tax is 300 million. The company may decide to pay out 250 million as dividend and retain 50 million for reinvestments. Another company may decide to pay out 200 out of the 300 and retain 100 million for reinvestments. Based on the Gordon's growth model, he believes that company that retains part of their profit for reinvestments will end up increasing in value